the Supreme Court will resume hearing.
All right, Ashwin, thank you very much for that. So that is, I mean, of course, different aspects of this issue, which is now kind of broadening out to the courts as well. So that's the Adani story for you. 50 points higher, so still holding on to gains. We are at about 17,823. We'll highlight more stuff which is moving around. Just what, 6 or 7 minutes into market open so far. Now, Sundaram Finance posted an operationally weak set of third quarter numbers. But it is the only commercial vehicle player to see disbursal growth in single digits on a quarter-on-quarter basis. Profit after tax is up 20% on a year-on-year basis. We have Rajiv Lochan, Managing Director at the company, joining in to take some questions. Rajiv, great to have you with us here. Appreciate your time. Thanks very much. Prashant this side. Could you start with what was the reason behind the tepid net interest income growth? On a year-on-year basis, it was a bit subdued. What was the reason behind this, and how are things progressing in the fourth quarter so far, the Jan to March quarter we are in so far?
Well, good morning, Prashant. Thanks for having us back on the show. Always happy to be here. I've explained this net interest income, net interest margin in past appearances as well. 2 or 3 factors are at work here. First of which, of course, all of us know interest rates have moved up and therefore cost of borrowing has moved up. In a sense, we are coming back to pre-COVID levels of cost of borrowing, and we are seeing the repo rate back very much at pre-COVID levels. The second is, M&HCV, which has been an important asset class for us, has been weak in the last couple of years, and that we are seeing a relatively strong bounce back this year. The upcycle of the M&HCV that I've discussed with you is now well underway. And so M&HCV business as a mix of our disbursements has gone up. M&HCV, as you know, is a heavily competed segment with a great deal of pricing pressure from banks. And so that naturally brings the margin overall for the portfolio of ours a little bit lower. So combination of cost of borrowing moving up and the asset mix shifting back to the M&HCV segment is causing this. Frankly, we see no reason for concern. Because all indicators, external macroeconomic indicators, high-frequency indicators are all moving back to pre-COVID levels. And our net interest income and net interest margin is also, in a sense, moving back to pre-COVID levels. We should see that, expect that across the system. This is not something unique to us, I would argue. You will see in the next couple of quarters across the system net interest margins reverting back to pre-COVID levels, which is, again, just a natural phenomenon. What goes up must come down. To long-term sustainable levels. And that's what I think we're beginning to see.
Rajiv, last time also when you were on late December, you said, we can't be sure about the rate trajectory, interest rate trajectory, but hopefully we are close to a peak. We got the inflation number yesterday, Rajiv, which was a big negative surprise, and which means that maybe there is more left here in terms of rate increases, etc. How does that change? Economists are penciling in another 25 basis points, which will get passed on. So does that change how you look at things?
Prashant, you are correct. This was a little bit of an unexpected adverse surprise, the inflation print that came. But I think the long-term direction of inflation is headed in the right way. We should expect quarter-on-quarter movements up and down. So at least we remain focused on looking at what the long-term direction is and taking sort of a through-cycle view. The fine balance between growth, managing inflation, and also getting the currency under control, that impossible trinity, I think, is what the regulator will do a job trying to balance. And in that process, there will be a little bit of movement back and forth. From our vantage point, I think the sensible thing for us to do is, again, focus on ensuring that we can transmit the rate increase to customers as best as possible, ensure that we get the right customer segment mixed within each asset class, and get the right asset mix across our diversified asset portfolio so that we are getting the right balance in terms of yields that we can get. So that's the approach that we're taking. We think, again, over the next few quarters, things will smooth out. And so worrying about quarter-to-quarter movement is something we're not too fussed about.
You also mentioned that the MHCV competitiveness is something that has perhaps hurt margins. If you compare your performance to your peers, the disbursal growth has also been subpar. I mean, you've seen about a 8% disbursal growth on a quarter-on-quarter basis, while a lot of your peers have gone into double digits. Why is that, and what kind of a trend do you see in both Q4 and FY24 in terms of disbursals?
Yeah. So, Sonia, good morning. Nice to connect again. When I assume when you say peers, you're looking at our NBFC peers.
Yes.
I would argue that the NBFC peers are actually have a very different asset mix. I think they've moved away towards the lower end of commercial vehicles, much more towards passenger cars, a lot more towards loans against property, SME kind of portfolio. So I would say there's very limited comparison as far as MNHCV is concerned compared with our traditional NBFC peers. If you look at our own trajectory, we're quite pleased with what we're doing. Quarter on quarter, we are seeing highest ever disbursement levels, well above pre-COVID levels. And we firmly re-established the pre-COVID trajectory that we were on. And so striking the balance between growth, quality, and profitability. Like the regulator has an impossible trinity, we have this trinity that we work with of growth, quality, and profitability. And all those parameters are trending in absolutely the right direction. We expect to close this year at highest ever disbursements. We expect our asset quality to be back to pre-COVID levels, and we expect to deliver healthy profit growth. I think that balance is what our stakeholders, investors, employees are working towards and expect from us.
Okay, all right. Hi, Rajiv. Good morning. This is Nigel on this side. Going by all that you say, let's try to put it in a couple of numbers then. Disbursals are strong. What kind of an AUM growth are you going to end this year with, as well as for FY24? So that's point number one. And NIMs, as you mentioned, they're going to be returning to pre-COVID levels. So what's that number we should be working with? A broad range, given that cost of borrowing as well has gone up.
Good morning, Nigel. As you well know, we don't guide from a forward-looking standpoint, so I prefer not to start a new tradition on the show this morning. I will simply say that we are expecting to continue the trajectory that we are on. We expect the market to get back to a healthy pre-COVID double-digit growth level across all asset classes. In the commercial vehicle segment, we are clearly seeing firmly the start of the upcycle. We are now already back to, I'd say, close to the 17, 18 highs that we've seen as far as MNHCV is concerned. Retail commercial vehicles, SCV and LCV are establishing new highs. Passenger car demand remains robust. Anish was on your show yesterday saying there's a hell of a lot of backlog that they're working with. Likewise with Maruti, Tata, everybody has got a lot of backlog. Tractors are looking very strong. And with the 10 lakh crores of construction and infrastructure investment the government has just announced, we expect construction equipment, which is another important segment, to grow as well. So as far as we can see, there's robust growth opportunity. And our focus remains explicitly on protecting our market share and growing it. So depending on how the cycles move, we will preserve our market share.
So, Rajiv, if you quantify that, what is your market share? If you could give us a rough number out there. And also, going by all that you're saying, double-digit growth, AUM growth at least, is definitely doable, right, for FY24. We're not quantifying it, but at least double-digit growth.
No, there's no question of that, Nigel. I think just the arithmetics of it will ensure that happens. There are specific COVID-related implications around moratorium and restructuring that have depressed AUM growth, I would say, in the last 6 quarters or so. That will shake off, but more importantly, growth will securely be back. So that's what you should expect.
And margins, Rajiv, last time you were on, although not a guidance, but broadly should settle between the long-term range between 4-4.5%, right?
That's correct. I think historically, if you look back at the last 5 to 10 years, we've operated in the 425 to 475 range. I think in the COVID time, given the bonanza that all of us enjoyed, it went up quite substantially. But we think, that 450 to 475 kind of range is something we can consistently deliver over the long haul.
Right. Rajiv, from the last time that we spoke, which was not that long ago, you're sounding a lot more confident. I mean, back then you were saying that affordability is an issue because, I mean, the cost of, trucks, etc., is quite high, for smaller operators. So then demand becomes a bit of an issue. I think you'd pointed to, you said that you were in that CV cycle, you were three quarters of the way in, but there was still some distance to cover. But you're sounding, have things picked up, accelerated, as you see it, even from a month and a half ago?
Prashant, the small road transport operators continue to remain under pressure from a viability standpoint. I think the HCV has decisively moved up towards much higher tonnage. 45, 50, 55 tons are where the HCV is operating at, and therefore the asset cost has now moved up to north of 50 lakhs. So a small road transport operator with 2 or 3 vehicles is already looking at, EMI per vehicle north of 1.25 to 1.5 lakhs, which is quite hard to make work, given that freight rates have not moved at that pace and input costs have actually moved up. So I think M&HCV is for the small road transport operator a challenge. So what we are seeing is them moving towards used vehicles, which is I think a great opportunity, as also towards the intermediate commercial vehicles, which is now seeing historic highs in terms of production, sale, and therefore demand from our customers. So those trends I think are quite helpful.
I have to ask you a quick word on what's happening with the home finance business, because over there, you know, your asset quality has deteriorated quite a bit. Your customer base has declined. What are the steps that you're taking to address these issues, and what would be the long-term call on this business now?
Sonia, the asset quality issues are legacy issues, I would argue. And those are now in the process of being cleaned out, and we're ensuring that we're cleaning out the base and setting up a firm foundation for the future. At the same time, I think the growth that business is driving is again at a historic run rate, which we've never seen in the past. And so we feel quite confident that the doubling down on southern markets, looking at tier 3, tier 4 towns a lot more closely, cleaning out the legacy asset quality issues, focusing much more on the housing finance segment as opposed to builder finance, which we had a bit of focus on before, and driving productivity improvements through technology and digital are the big thrust areas there. We remain quite bullish and hopeful on that segment, especially as housing demand begins to pick up back to the pre-COVID levels.
Okay, all right, we'll leave it at that. Thanks a lot for joining in and you know, giving us your view. By the way, let's get back to the market now. It's picking up a little bit of pace. The Sensex